Hello everyone, this is Phil Yaeger, and today we're going to do a regulation topic. And once again, we asked people in our Facebook page, our Facebook list, what topics would you like me to go over in a video? All right, and now we came up with the number. All right, here's the one. This is in regulation. It's called the Cost Recovery, including Depreciation. All right, now what does this mean? Well, basically, you have to know what amount of depreciation you're going to take the first year of the acquisition. Not the acquisition, but the date you place it in service. Now, this is called the averaging convention methods. The amount of depreciation you're going to take in the first year. All right, now, if you have personal property used in a trade or business, all right, if you have personal property used in a trade or business, all right, the first year averaging convention methods are either the mid-quarter method and if you don't meet the requirements for the mid-quarter method, then you'll take half-year depreciation. All right, now, when do you use the mid-quarter method? Well, if you look at your book, it says if 40% or more of the personal property, all right, if 40% or more of the personal property is placed in service during the fourth quarter, then in the year that you actually place the assets in service, you have to use the mid-quarter convention method. All right? If 40% or more of personal property is placed in service during the fourth quarter, the last quarter of the year, then you have to use the mid-quarter convention method. But if that's not the case, and you don't have 40% or more of the personal property placed in service during the fourth quarter, all right, then you will use the half year, which means you'll take half-year depreciation for that personal property. All right? So first you see if you apply the mid-quarter. If you don't, then you take a half year for personal property used in a trade or business for the first year. All right? Now, what about real estate used in a trade or business? Well, if you're dealing with real estate, there's only one averaging convention method called the MidMonth Method. Now, the MidMonth Method says this. Let's assume that I placed the first year, I placed the asset in service on April 30th. All right, 2019. All right, now, what do you do the first year? Well, you go to the month you placed it in service, and you assume you placed it in service in the middle of this month. So therefore, the asset will be depreciated from April 15th, 2019. All right, we're assuming they have a calendar year. All right, you will take depreciation till December 31st, 2019. So the first year, all right, you're only going to take depreciation from April 15th, 2019, the middle of that month, to December 31st, 2019. Okay? Now, what method do you use? Well, first of all, if you're dealing with personal property used in a trade or business, the maximum depreciation under makers is this. And here's the assets they give you, all right? If they give you, for example, machinery and equipment, all right, it'll be what? 5 year, and we use double declining balance, all right? Now, that also includes computers. So computers and autos are also 5-year double declining balance. Now, if you place in service furniture and fixtures, That will be 7-year double declining balance. Now, what's the lives for real estate under makers? All right, for real estate, it's going to be straight line depreciation. And if it is residential rental property, residential rental, all right, then you use 27 and a half years, all right, as the life for that. But if it's non-residential, such as an office building, a warehouse, all right, that's 39 years straight line, okay? Now, a lot of times on the exam, what they'll do is they will give you the factors because they're actually factors. They have depreciation tables. Now, if you go into these depreciation tables, all right, first of all, the tables will have this, all right? They'll have the lives of the assets, okay, broken down by lives, all right, broken down by, whether it's personal property, real property, all right, and also, all right, built into those tables is the averaging convention methods, all right? Now, what should you do? Go to Google and put in makers depreciation tables, and you can look at those. Now, the factors in those tables take into account the averaging convention method for the first year, the depreciation you take for the first year. Also, all right, please remember that for the second year, using those tables, all right, it will take into account that, all right, you subtracted the depreciation from the first year if you're using double declining balance, and it'll calculate the depreciation for the second year. Okay? All right? So, you don't have, all right, just remember, if you use the tables, personal property used in a trade or business, double declining balance, the first year's factor will include the averaging convention method. Okay? All right? The second year, if it's double declining balance, the factor will take into account, you have to subtract the depreciation you took the first year under double declining balance, and the balance, after you take the depreciation, times the second year factor, will give you the full year depreciation for the second year. And don't forget this, all right? If you take a half year instead of the mid-quarter method, all right, the assumption is what? That you take the other half year in the year you dispose of the personal property used in a trade or business. So make sure you're familiar with those tables, all right? You just type in Google, makers depreciation methods, look at it and practice with the tables, all right? Because they like to give the factors. And people then get all right? You don't have to do it manually, all right? They're giving you factors. Try it, work with the factors, see if you come up with the answers. All right, now, also, one other thing under cost recovery is this. We have, for personal property used in a trade or business, not real estate, all right, you can take an expense deduction called Section 179. Now, don't worry necessarily at this point what the amount is. Yes, you're going to have to memorize the amounts, all right? They're different for each year. So just go to your CPA review and they'll tell you, all right, what the amounts are and what's the phase-in. But this is what you have to remember. When you're doing, and by the way, Section 179 is the first year. So this is what you do. It only applies to personal property used in a trade or business. All right? You don't take Section 179 on real estate. So this is the order. This is the order. The order you get is this. You take the cost of the personal property. Did I spell it right? P-R-S-O-N-A-L. All right, you take the cost, whatever it is. All right, the first thing you determine is your Section 179 deduction. Now, a lot of times in the questions, they'll say, all right, for this year, all right, the Section 179 deduction was $100,000. All right, they'll give you the amount because it changes each year. All right, now you subtract that, and then you have a basis. The next thing you take, and by the way, the next thing a taxpayer can take is bonus depreciation. And that's only on what? Personal property used in a trade or business. So this is the first year, this is the first year. Then you have a basis, and this remaining basis, all right, will be subject to the averaging convention amount. Now, for real estate, all right, you take the cost of the real estate. Now remember, land you can't depreciate. So if you have a building, all right, what are you going to take the first year? You're not going to take Section 179. You're not going to take bonus depreciation. And you're not going to, oh, well, you will take the averaging convention. But whatever this amount is, for the first year, you will apply the averaging convention amount. Which, if this is real estate, it's only the mid-month method. And remember, the averaging convention is the maximum depreciation you take for the first year only. Okay? And then you'll have your basis if you decide to sell the asset. All right? But once again, there are tables for each asset. The lives, which is either 27.5 years or 39 years for real estate. All right? And also, the factors take into account the averaging convention amount. All right? But the factors in the table do not take into account Section 179 if it's personal property. So you're going to have to subtract first the Section 179. And then the factors do not include bonus depreciation. So if you're dealing with this situation, all right, you have personal property, you're going to have to manually subtract Section 179 basis. Then you're going to have to subtract bonus depreciation. That's not included in the factor. Then, whatever this amount is, you'd multiply the factor, all right, and look at the averaging convention method, take the life, and then it'll give you the averaging convention amount. So if they say to you, what's the total depreciation for this personal property? It'll be the Section 179, which you can only do manually because 179 and bonus depreciation is not included in the tables, all right? It's not included, all right? The only thing that factor includes is the averaging convention amount, all right? So your total depreciation for the year would be Section 179, the bonus depreciation, and the averaging convention for that first year, all right? Make sure you know that, okay? Make sure you know that. And, all right, be familiar, for example, with leasehold improvements. All leasehold improvements, whether they're restaurants or, you know, leasehold improvements, if you put a store in a mall, all right, those are all written off, all right, I hope I'm right on this. I believe it's 15 years straight line. And, all right, with leasehold improvements, you can take Section 179 and the bonus depreciation. Okay? All right? And remember now, effective for the Tax Cuts and Jobs Act, all leasehold improvements are actually what? All right? They're included as one item. We no longer have leasehold improvements for restaurants, all right? Leasehold improvements for other, you know, everything is grouped together as one leasehold improvements account, okay? Remember, straight line, 15 years. And it's eligible for what? 179 and also bonus depreciation. All right, but anyway, go over those areas, all right? Hopefully your course, all right, will cover those areas. But I've given you the key things with these cost recovery, including depreciation, okay? Anyway, Phil Yaeger is here for you. If you need me, my phone number is 301-874-4900, 301-874-4900, and I'm at extension 55. All right, if you have any questions on this depreciation stuff, please give me a call. Be happy to answer your questions. Honestly, you'll get me on the phone. Maybe hard to believe, huh? All right, thank you, everyone. I hope that helped you on depreciation. Take care and good luck with regulation. Thank you.